Hello everyone, welcome to today's lecture video. Today we will be covering chapter 5, which is about risk, return, and the historical record. So starting off with a quick chapter overview, first we will present tools for estimating expected returns and risk from historical record. We will look at interest rates and investments in safe assets, and also the history of risk-free investments in the U.S. We will then conduct scenario analyses of risky investments and the data inputs necessary to conduct it. And then lastly, we will develop statistical tools needed to make inferences from historical time series of portfolio returns. So before we can evaluate returns, we first must be able to calculate a return. So first what we will be doing is conducting what is called a holding period return, or HPR. A holding period return is the rate of return over some given investment period, and it is calculated by taking the price increase in that investment plus any income that you received, and you divide it by the beginning price. If we want to break down the holding period return a little bit further, your holding period return could be broken down into two components: a capital gains yield and a dividends yield. A capital gains yield is simply the increase in the price of the security. So here what we have, let me change my color here. What we have is the ending price minus the beginning price, and we divide it by the beginning. And then the dividend yield is simply the income that you received. If it's a stock, it's your dividend amount. If it's a bond, it is your interest or your coupon amount divided by your beginning price. So as I mentioned, your holding period return can be broken down into a capital gains yield and a dividend yield. And when we are dealing with stocks, we assume that the dividend is paid at the end of the holding period. So let's take a look at an example. You purchased a bond 72 days ago for $901.49. You received an interest payment of $28 62 days ago. Today, the bond price is $939.14. What is your holding period return on the bond as of today? So over this 72-day period. As I mentioned, your holding period return is simply equal to your ending price minus your beginning price, and you add any income that you received. In this case, it is interest, and we divide that by the beginning price. So inputting our values here, we had an ending price of $939.14 minus the beginning price of $901.49. We received $28 of interest over this 72-day period, and we divide it by the beginning price that we paid of $901.49. When we do our calculations, we get a value of 0.0728 or 7.28% return over this 72-day holding period. Now, you could actually get a negative value for your holding period return if the ending price is smaller than the beginning price and you ended up not receiving enough interest or income over that time period to cover that difference. But this is how you would calculate your return over a particular period. Next, how do we actually compare returns on investments that have different horizons, so different holding periods? What we must do is it is necessary to re-express each of these returns as a total return as a rate over some common period. And what we do is we create a rate of return based over some annual period. The first way is calculating an annual percentage rate. Your annual percentage rate is calculated by taking your per period rate multiplied by the number of periods, and I should say the number of periods per year. With your annual percentage rate, it ignores compounding. This annual percentage rate is what is called a simple interest rate. Due to the fact that it ignores compounding, it is simply your interest rate per period multiplied by the number of periods per year. On the other hand, we also have the effective annual rate, your EAR. This is the actual rate an investment grows. It is defined as the percentage increase in funds per year, and this does not ignore compounding. So this is your true rate of return, and it explicitly accounts for compound interest that you earn period over period. Now, where are these rates used? Well, any returns on assets that have regular cash flows, such as mortgages with monthly payments and bonds with semi-annual coupons, usually are quoted using that simple interest rate annual percentage rate. So it was a lot easier to identify what rate to charge on a loan, for example, if you knew the per period rate, and then you could just multiply it by the number of months in the year. So for example, let's say the bank wanted to charge 1% per month. A lot easier to calculate the APR, just 1% times 12, than the EAR. But it is important to understand that the EAR is the true rate and the rate that does consider compounding. Now, how do I make these calculations if I know the per period rate? If I have n periods of compounding, so monthly would be 12, semi-annually 6, quarterly 4, and so forth, your EAR equation is 1 plus APR divided by n, and this APR, your simple interest rate divided by the number of compounding periods, is simply your per period interest rate. So you just get 1 plus your per period interest rate, you raise it to the number of compounding periods per year, and then you subtract 1. Additionally, if you know the EAR and you need to calculate the APR, you can use the following equation where it's EAR plus 1 raised to the 1 over n power minus 1 multiplied by the number of compounding periods. And here I state that the n is the number of compounding periods per year. And then there are events where you actually have continuous compounding. So if the compounding is continuous, your EAR is equal to E raised to the APR minus 1, and E is approximately equal to 2.71828. And so you can calculate the EAR even if there is continuous compounding and you don't have a value that you can plug in for the number of compounding periods by using this E function. And then as a result, to solve for the APR, if you know the EAR with continuous compounding, you would take the natural log of 1 plus your EAR to solve for the APR. So let's look at an example. Suppose your credit card charges an APR of 18% per year with monthly compounding. To get the EAR, we would use the EAR equation of 1 plus your APR divided by n raised to the nth power minus 1. Remember that this APR divided by n is just simply your per period interest rate. So what this would imply is that your EAR is equal to 1 plus 18% per year divided by 12. So this is meaning that they are charging 1.5% per month. We would take that value, raise it to the 12th power, subtract 1, and we would get an EAR of 19.56%. Your EAR will always be greater than your APR if you have more than one compounding period. So that APR is a simple interest rate. That EAR is the true rate, the rate that does take into consider compounding. Now let's kind of throw everything together here with holding returns and also EAR and APR and do a comprehensive example. So our firm just invested $2,509,200 in a 270-day commercial paper. At the end of the investment period, at the end of these 270 days, the firm will receive $2,599,800. What is the 270-day holding period rate of return on this investment? Now, with this particular example, there's no interest being charged, or no interest being accumulated, I should say. So our holding period return is simply the ending price minus the beginning price divided by the beginning price. So rather straightforward in our calculations here. The ending price is $2,599,800 minus the beginning price of $2,509,200, and we divide it by the $2,509,200, and we get a holding period return of 0.0361 or 3.61%. So over this 270-day period, our return is 3.61%. Now, let's convert this to a common rate over an annual time period. And so the first thing that we must do is identify how many 270-day periods are there in 1 year. So what is the number of compounding periods per year? So what we would do is take the 365 days in a year divided by the 270 days of this investment horizon, and we get an answer of 1.3519 270-day periods per year. Let me clear up my handwriting there a little bit. So this is simply telling us that there are 1.3519 compounding periods per year in this 270-day investment horizon. So what is the annual percentage rate on this investment? Well, we said that your APR is your interest rate per period. Your interest rate per period multiplied by the number of periods. We have these two values here from parts A and part B. So the interest rate per period is 3.61%, And there are 1.3519 periods per year. So our APR, the annual percentage rate, the rate that ignores compounding, is 4.88%. And as you can probably imagine, the next step then is to calculate the EAR. What is the effective annual rate, the rate that does consider compounding? So once again, your EAR equation is 1 plus your APR divided by N. So what is your per period rate raised to the number of compounding periods minus 1. So we just input our values. I could type in the 4.88 APR and divide it by 1.3519, or I already know what the per period rate is. It is the 3.61. And notice that I made the conversion here into decimal form since I am using an equation here. And I'm going to raise it to the number of periods per year, which is the 1.3519, and I subtract 1, and I get an AP or an EAR of 4.91%. So as I mentioned, slightly higher than the APR. EAR will always be higher if there's more than one compounding period. So that is taking an investment, calculating your holding period return, and then being able to adjust that holding period return to an annualized value so that you can compare investments that have different holding periods. Next, what we will move on to is interest rates. So level of interest rates is among the most important macroeconomic factors that guide investment analysis. So what are the fundamental factors that determine this level of interest rates? So the fundamental factors that determine the level of interest rates are primarily based on 4 different factors. First is the supply of funds from savers, primarily households. Second would be the demand for these funds from businesses to be used to finance investments in plant, equipment, and inventories. Then the government's net demand, are they borrowers or suppliers for funds as modified by actions of the Federal Reserve Bank, which we've discussed in previous chapters. And then also, what is the expected rate of inflation? So before we go into more of a discussion on these these levels of interest rates, let's first identify the difference between a nominal rate and a real rate of interest. A nominal rate of interest is the growth rate of your money. So what rate has your funds increased? So for example, let's say I start at the beginning of a period with $100. At the end of the period, I have $110. My nominal interest rate is 10%. My number of funds have grown by 10%. On the other hand, then, we have what is called a real interest rate. The real interest rate is the growth rate of your purchasing power. So what increase in purchasing power do you have from those funds? So what could I buy? What could I buy of a basket of goods with $100 at the beginning of the period, and how much of that basket of goods could I buy at the end of the period with the $110 based on changes in the values of the underlying inputs of that basket of goods. So I've lost some of my equations here. Let me just throw these in real fast. So what we have here is a relationship between the nominal rate and the real rate, and it includes the inflation rate. So the inflation rate is measured by changes in the consumer price index, so the pricing of goods. And this relationship was created by the economist Irving Fisher. You've probably seen this in the past if you've taken other finance courses, referred to as the Fisher effect, or our textbook actually calls it the Fisher hypothesis. And he argued that the nominal rate, so the growth rate of your actual funds, should increase 1-for-1 with whatever the expected inflation is. Now, you've also probably seen this equation written slightly differently. You may also see this Fisher hypothesis written as 1 plus your nominal return is equal to 1 plus your real return multiplied by 1 plus your expected rate of inflation. These two are the same equations. So this equation and this equation are the same. They're just organized to isolate the real rate there. But that is the Fisher hypothesis. It is a relationship between the real rate, the nominal rate, and the expected inflation rate. Now note that there is also an approximation that says your real rate is approximately equal to your nominal rate minus your rate of inflation. And basically all it's stating is that you would expect higher nominal rates when inflation is higher, right? To compensate for the decrease in your purchasing power, you want to maintain that same real interest rate on whatever investment that you're looking at. So let's take a look at an example. Example number 1, suppose that the real interest rate is 3% per year. So your purchasing power is increasing 3% per year, but the expected inflation rate is 8%. What would be the nominal interest rate? So using the Fisher hypothesis of 1 plus your nominal rate, equal to 1 plus your real rate multiplied by 1 plus the expected rate of inflation, we can see that we would have the nominal rate being equal to 1 plus 0.03 multiplied by 1 plus 0.08, and then we subtract 1, and I would get a nominal rate that is equal to 0.1124 or 11.24%. That is the exact value for the nominal rate based on the given real rate and expected inflation rate. The approximation, if you look back at the previous slide where the approximation says that the real rate is approximately equal to the nominal rate minus inflation, if the real rate is 3% and inflation is 8%, then the approximation says that the nominal rate should be 11%. So in the ballpark, but not the exact value. Now, suppose that the expected inflation rate rises to 10%, so a 2% increase, but the real rate is unchanged. What happens to the nominal interest rate? So once again, I'm going to be using the Fisher hypothesis, and what I get is a nominal rate that's equal to 1 plus the still 3% real rate, but now the rate of inflation is 10%, and what you would see is you get a value of 0.133, or a nominal rate of 13.3%. So it increased slightly more than the 2% increase in inflation, but you can see this relationship between real rates and nominal rates. Let's take a look at another example. So during a period of severe inflation, a bond offered a nominal holding period return of 79%, but the inflation was 69% per year. What was the real holding period return on the bond over the year? So what is the real holding period return? Well, if you look back at your equations, I'm going to use the condensed form that already has the return of the real isolated. It said that the return of the real is equal to the nominal rate minus the expected inflation divided by 1 plus your rate of inflation. And so what we get when we plug in our inputs, the nominal was 79% minus the rate of inflation divided by 1 plus the rate of inflation, and you would get a real return of 0.0592 or 5.92%. Now for part B, they want us to find the approximation and then compare it to your answer in part B to the compare your answer in part B to the one in part A. So the approximation says that your real return is approximately equal to your nominal minus inflation. So your nominal minus inflation would be 0.79 minus 0.69. And you would see that the approximation for your real is 10%. So not really close to the 5.92% exact value. So clearly the approximation gives a real holding period return that is too high. So this approximation equation does have its limitations. Now, I mentioned that we would go back to the fundamental factors of interest rates. Let's take a look at a supply and demand curve to look at at what actually determines the equilibrium real rate of interest. So here we have a demand curve and a supply curve. Notice that the demand curve here is downward sloping. So let's break down the chart a little bit more. We have our real interest rate on the vertical axis. We have our funds on the horizontal axis. And as I mentioned, your demand curve is downward sloping, meaning that at lower interest rates, there's more investments occurring in physical capital. And then with your supply curve, it is upward sloping, understanding that at these higher interest rates, so on your vertical axis, as you have higher interest rates, there's more savings available. You're not really spending your funds. And so let's talk about what would happen to the demand and supply curve under different scenarios. So let's say, example number 1, the government will increase their budget deficit. So what happens when the government increases their budget deficit? There is more borrowing that's occurring. So what would happen is the demand curve would shift outward. So what would happen with the demand curve shifts outward? You can see this is exactly what the chart is actually showcasing here, is that we would have a new equilibrium point and the real rate would rise in the event that the government is borrowing more. The demand for these funds is increased, shifting our demand curve on our equilibrium real rate of interest chart. Now, what's another example? Let's say that the Federal Reserve conducts expansionary monetary policies. So we talked about this in a previous chapter. How do they conduct expansionary monetary policy? Let's say they decrease the federal funds rate. So if they decrease the federal funds rate, the supply curve actually shifts. Why? Because this would encourage banks to lend more, so the supply curve would actually shift right. So if the supply curve were to shift right, what would happen then to our new part? We would have a lower real interest rate. So anything that would affect the supply and demand of these funds impacts the equilibrium real rate of interest. And once again, the real rate of interest is that change in your purchasing power. Next, risk and risk premium. So how do we measure risk? The first thing that we will be conducting to measure risk is we are going to conduct what are called scenario analyses. So scenario analyses and probability distributions. What is a scenario analysis? It is the possible, within a scenario analysis, what you do is you estimate possible economic scenarios, and then you specify the likelihood of each scenario and the holding period return under each scenario. You would have probability distribution, which showcases the possible outcomes with different probabilities that occur. And then once you have this, you will calculate an expected return, which is a mean value or an average value of the distribution of your holding period returns. Once you have this average, then you can calculate the variance, which is the expected value of squared deviations from the mean. And then you will calculate the standard deviation, which is the square root of variance. And this standard deviation then will measure the riskiness of the actual returns. So what are the equations for calculating expected return, variance, and standard deviation? First of all, to calculate expected return or your mean return, your average return, the equation says that you would take the sum of the probability of each economic condition multiplied by the return in that economic condition. So you take the probability of each condition multiplied by the return of each of that said condition, and then you add up all those values. That's what the sum value is there in the front. To calculate the variance then, it is the sum of the squared deviations from the mean. So the squared deviations from the mean, the sum, and we get this what is called population variance by multiplying these squared deviations from the mean by the probability of each economic condition. So what is the probability of the economic condition? What is the return in that condition? And then we have the subtraction of the expected return that we calculate first. Then for population standard deviation, you would take the square root of that variance value. So obviously, kind of verbally stating what's going on here, let's go ahead and go through an example. So in example number 1, what is the standard deviation of the following random variable x with the following probability distribution? So the value of x could be 0, 1, or 2. The probability that it is 0 is 0.3%, is 0.30, so 30% probability, 20% probability that is a value of 1, 50% probability that it is a value of 2. So if you have not written down those equations on the previous slide, to calculate the expected return, we take the value multiplied by the probability plus value multiplied by probability plus value multiplied by probability. So the sum of the probabilities multiplied by the value. So we have 0.3 probability multiplied by the value of x being 0, plus 0.2 probability multiplied by the value of x being 1, plus 0.5 probability or 50% probability multiplied by the value of x being 2. And we end up getting an expected return or a average of these inputs. Since we're not dealing with the percentage return here, we're just dealing with the value of an input. We get an average of 1.2. To calculate the variance, which we are still just going to go ahead and keep it as the same notation as before. So the variance of this return, sigma squared, is equal to probability multiplied by the deviations from the mean squared. So in this first scenario with 30% probability, the value of x is 0 minus the mean that we just calculated, and we square that difference. We add to it the probability of the second scenario, which is 20%. In that probability situation, the value of x is 1 minus the average of 1.2 squared, and then we add to it the final probability, 0.5. In that scenario, the value is 2 minus the average 1.2, and we square that again. You do all these calculations, which can be a little bit difficult with your financial calculator, so you may want to utilize Excel on these, but what you'd get is a variance of 0.76, and then the standard deviation of this is simply the sigma, which is the square root of your variance, and we get a standard deviation of 0.87178. Variance units change since we are squaring things. The standard deviation has the same units as whatever your input is. In this case, it's just simply a value of x. So your standard deviation is 0.87178, whatever units this x input is. So let's take a look at another example dealing with returns. So now let's say we suppose your expectations regarding the stock price are as follows. In a boom economy, the probability is 30% that the economy or the market is in a boom state. The holding period return would be 49%. With a normal probability or a normal state of the market, the probability is 45%. In that case, the return is 17% holding period return. And then the probability of a recession is 25%. In that case, the holding period return is a negative 13.5%. And they want to know what is the mean and the standard deviation of the holding period return on the stock. So the mean is simply the average. So the mean is your expected return. To calculate the expected return, you take the probability multiplied by that price or that return plus probability multiplied by return plus probability multiplied by return. So what we have is a 30% probability of a boom. In the event of a boom, I have a 49% return. I add to that the probability of normal multiplied by its return of 17%. And I add to that the probability of a recession multiplied by its return, and what I get is an expected return of 0.18975 or 18.975% would be the expected return in this case. And now they want us to calculate the standard deviation. In order to calculate the standard deviation, I need to first find the variance. So what is the variance here? Remember, you take the probability, so the probability of that boom, and then we subtract the deviation of the return in that condition minus the expected return that we just calculated. So in a boom economy, the return is 49% minus the expected return we just calculated of 0.18975, and we square that deviation. Please keep in mind your order of operations, so you would first have to do within the parentheses and square it and then multiply it by the probability in order to get the correct value for each one of these steps. So step 2 then, you take the probability of a normal growth of 0.45. In a normal growth situation, the holding period return is 17% minus the expected return we just calculated of 18.975%. We square that deviation, and then last up, hopefully you're seeing that we would take the 25% probability of a recession. In the event of a recession, the return is negative 13.5%. We subtract the expected return of 0.18975, and we square that deviation. And what we get is a variance of 0.053586. And then to calculate the standard deviation is the square root of that value. And you get a standard deviation of 0.231487 or 23.15% would be the standard deviation, and that measure is a risk. It measures the riskiness of the returns. Notice what we did not use in this problem. We did not use the ending price of the securities. We are just taking the probability and the holding period returns to identify what the mean and the standard deviation is of the holding period return on these stocks. Now, continuing on, talking about risk and risk premiums. So what are these things? Well, first of all, the risk premium is the difference between the expected holding period return and the risk-free rate. So this is what provides compensation for the risk of an investment. So what is the additional return that you're gaining by taking on some level of risk? The risk-free rate is the rate of interest that can be earned with certainty, so you're taking on no risk here. It is commonly taken to be the rate on short-term treasury bills. They say that these are risk-free investments. The difference between the actual rate of return and the risk-free rate. So notice the difference here. Risk premium is the difference between the expected holding period return. The difference between the actual rate of return and the risk-free rate is called excess return. So risk premium is the expected value of the excess return, and the standard deviation of the excess return then is a measure of its risk. Now, risk aversion dictates the degree to which investors are willing to commit funds to stocks, so take on some amount of risk. So stocks are risky investments when compared to your risk-free investments. And if you are less risk averse, it means that you are willing to take on more risk. Now, risk and risk premium. So previously, what we've been looking at is scenario analysis. So with scenario analysis, we were looking at different scenarios. We would assign probabilities and then the associated rates of return under each scenario. Then we calculated the average or the expected return, and then the standard deviation of the proposed investment. Now with time series, what you do is you look at past returns and you look at the associated holding period returns underneath these previous conditions. So what we will be turning our focus to now is focusing on time series as opposed to the previous ones, which were scenario analysis. So before we can get into a time series analysis, the first thing that we need to do is be able to calculate an average. So how do I calculate an average within time series? There's two ways. The first is calculating the arithmetic average. The arithmetic average is simply the sum of the returns in each period divided by the number of periods. So each observation is treated equally, assigned an equal weight. The equation can look a little bit confusing here. This part right here is simply what we did with the scenario analysis. So we took the probability and multiplied it by the return. With time series, you take the return of each individual input and you divide it by the number of observations. So to simplify this, it's simply the return under each condition multiplied by the number of conditions. Okay, so this is just kind of relating a scenario analysis with what a time series analysis is doing. Continuing on, the other type of average is what is called a geometric average. Your geometric average is the compound period by period return, and it gives the same cumulative performance as sequence of actual returns. To calculate it, you multiply the return, so 1 plus return times 1 plus return for each of the different periods, and you raise it to the 1 over number of observations as your exponent, and then you subtract 1. This geometric return is also called a time-weighted average return. Now that we know how to calculate an expected return or an average based on these time series, let's move on to calculating variance and standard deviation. To calculate variance, it's very similar to our scenario analysis, where we take the deviations from the mean, the average, but as you can see here, the first part of the equation, this is your scenario analysis. With a time series, instead of multiplying by the probability, the deviations from the average or from the expected return, what we do is we divide by n. So once again, we are equally weighting all of our deviations from the mean when calculating the variance. With the standard deviation then, it is simply the square root of that variance value. So once again, the way the equations are kind of set up, they first give you how we did it or how we calculated it when we did a scenario analysis under different scenarios that were assigned different probabilities. With time series, what you do is you take the deviations from the average. This average can also be replaced with R bar, which is just the average of your observations, and it is your arithmetic average. So add them all up and divide by the number of observations. And then you divide these square deviations by n, or this is simply showcasing that you are summing it is the summing of the squared deviations with each observation having the same equal weight. Now, when you are calculating variance and standard deviation by providing each individual observation the same equal weight, there is a thing called a degree of freedom bias. So when you calculate variance using the arithmetic average, which is what this the expected return is showcasing there, instead of actually using the expected return, which is actually unobservable, you are actually having some type of bias in your calculations. So what you can do is you can eliminate your bias by multiplying by n over n minus 1, or simply taking the sum of the squared deviations, and instead of dividing by n, you divide by n minus 1. Okay, so I know I've kind of been blabbering on here. The biggest thing in the difference between a scenario analysis and time series analysis is notice that with a scenario analysis, you multiply these by the probability, and when we do a time series, we are going to divide by n minus 1 instead. So, learning from historical returns. That's our next thing, is to go ahead and learn from these historical returns. Investors price risky assets so that the risk premium will correspond with the risk of the expected excess returns. So it is best to measure the risk by the standard deviation of your excess returns, not your total returns. So the excess returns in terms of investing in some type of risky asset instead and replacing your investment in non-risk assets, your treasury bills, and replacing it with an actual risky portfolio. And what it does is it introduces a new thing called a Sharpe ratio. This is widely used to evaluate performance of investment managers, and to calculate it, it is the risk premium, so the excess, your risk premium, divided by the standard deviation of those excess returns. So to calculate it, you take the expected return minus the risk-free rate, and you divide it by the standard deviation. So what is a good Sharpe ratio that will indicate a high degree of expected return relatively for a relatively low amount of risk? Well, usually if you have a Sharpe ratio that is greater than 1, it is considered acceptable to good by investors. If you get a Sharpe ratio that is greater than 2, that would be rated very good. A Sharpe ratio greater than 3 is considered excellent, and then any Sharpe ratio that is less than 1 is considered suboptimal. And so really all we're doing here with the Sharpe ratio is comparing the risk premium with the standard deviation of your excess returns. Moving on to normal distribution. What is normal distribution? Normal distribution is a bell-shaped. That's not the greatest bell, but you can catch the drift. I got an example on the next slide. Is a bell-shaped probability distribution that characterizes many natural phenomena. So heights and weights of newborns, test scores are different things that are considered normally distributed. And investment management is more manageable when returns can be well approximated by the normal distribution. Why? First of all, normal distribution is symmetric. So the probability of any positive deviation above the average or any positive deviation above the mean is equal to that of a negative deviation of the same magnitude, because your mean is in the middle here and you have deviations positively and negatively from that mean. Normal distribution is also stable. So when assets with normally distributed returns are mixed to construct a portfolio, the portfolio's return would also be normally distributed. And what's nice about normal distribution is it is completely defined by mean and standard deviation. So all you need is mean and standard deviation. There's no other need for any other statistic to learn about the behavior of returns. And statistical relation between returns can be summarized with a single correlation coefficient. So let's take a look at normal distribution and what this bell curve looks like. As you can see there in the middle, you would have your average return, so a mean of 10%. That is in the middle of our normal distribution. What normal distribution can help you identify is where a return falls in relation to that mean. So here we have a standard deviation of 20%. 68.26% of returns will fall within plus or minus 1 standard deviation of the average. Now, an even greater amount, 95.44% returns fall plus or minus 2 standard deviations of the mean, and then 99.74% plus or minus 3 standard deviations from the mean. So you can predict where a value or what range of inputs you can get if you know the average and the standard deviation of the data that has been analyzed. So let's take a look at an example here. So the continuously compounded annual return on a stock is normally distributed, so we have that bell-shaped distribution. The mean or the average is 14%, standard deviation is 30%. With 95.45% confidence, we should expect its actual return in any particular year to be between which pair of values. So at the 95.45% confidence with normal distribution, that would be plus or minus 2 standard deviations of the mean. So all you would do is take that mean of 14%, subtract 2 standard deviations. So 2 times the standard deviation of 30 would give you a lower bound of negative 46% of your return, and then the average plus 2 standard deviations, 2 times the 30 standard deviation, will give you the upper bound of your confidence interval. So with 95.45% confidence, we would expect the actual return to be between negative 46% and 74%. Yes, a very wide range, but we have some confidence as to where we can expect the returns to actually fall. Now, what if it's not normally distributed? What are some deviations from normality and introducing what is called tail risk? So focusing on extreme losses or extreme gains. So what if the returns are not completely normally distributed? We first introduce what is called skewness. Skewness is a standard measure of asymmetry in the probability distribution of returns. So it's called the skew of the return. So standard deviation and the Sharpe ratio are no longer a complete measure of risk. Those are only if the returns are normally distributed. And what we get is skew being equal to the average of R minus the average return cubed, and then we take the standard deviation cubed. I apologize for the signs not transferring over to the PowerPoint, but notice that this is a cubed deviation. So with the cubed deviations, no longer do our negative values, our negative returns turn out to be positive like they would if they were squared. Now if I have a negative deviation being raised to the third power, it's going to remain negative. So if your skew overall is negative, it would mean that extreme bad outcomes are more frequent than extreme positive ones. So when you're looking at your standard deviation is actually underestimating the risk because you have more bad outcomes. They're more frequent than your good outcomes. Now, on the other hand, if your skew is positive, then your extreme positive outcomes dominate, meaning that your standard deviation actually overestimates risk. And I'll show you a chart here on the following slide of skewness, both positive and negative skew. The other type of deviation from normality involves kurtosis. Kurtosis concerns the likelihood of extreme values on either side of the mean at the expense of a smaller likelihood of moderate deviations. So once again, it is looking at the tails of your normal distribution chart, and what kurtosis does is it measures the degree of fat tails, a measure of tail risk. So primarily focused on the risk of outcomes in the far tails of your probability distribution. The kurtosis equation is equal to the average of the return minus the average return, and then we take the standard deviation and raise it to the fourth power and subtract 3. Now, you're not going to be required to actually compute skew or compute kurtosis, but it is important to understand what they're showcasing. With kurtosis, a high kurtosis means that there is more probability mass in the tails of the distribution than what normal distribution showcases. So you still have symmetry, but the standard deviation is going to underestimate the likelihood of extreme events, both large losses and large gains. So let's take a look at the two skewness and kurtosis charts. Here you can see we have normal distribution in our light gray chart where we have that bell-shaped. If it's positively skewed, this is where standard deviation actually overestimates risk because you have more of your returns above the mean. If you have negative skew, the standard deviation actually underestimates risk, looking at this blue line, because you have a greater amount of your returns being below the mean. Then with kurtosis, you can see that we still have symmetry here. So we still have symmetry, but the tails are a lot larger. So there's a higher explanation of extreme losses or extreme gains. Now, what if you worry about some extreme event like the financial crisis of 2008 or the recession or a recession due to COVID-19? How do you estimate these loss scenarios? So these are called, this is called tail risk or black swan events, meaning that they only occur infrequently. But our focus here is what would happen for extreme losses. We're most concerned with these extreme losses, and these are the left tail scenarios. So focusing on the left-hand side of your normal distribution, as I mentioned, you're most concerned with the probabilities of extreme losses since gains are good from an investor's point of view. So looking at these, there are 3 main measures of downside risk, so measuring these extreme losses. First is calculating what is called value at risk. So this is the loss that will be incurred in the event of an extreme adverse price change with some given, usually low probability. So often what they'll do is they'll set a 1% value at risk. And what that 1% value at risk means is that 99% of the returns will exceed the value at risk, and then 1% will be worse. So it separates the 1% worst case scenarios from the rest of the distribution. Another measure of downside risk is called expected shortfall. It also goes by the name conditional tail expectation, and it is the expected loss on a security conditional on returns being in the left tail of the probability distribution. So let's say you have a 1% expected shortfall. You would identify the worst 1% of all observations and take the average. Another measure would be lower partial standard deviation, LPSD, and it is standard deviation computed using only the portion of the return distribution below some threshold, such as the risk-free rate or the risk-free rate of the sample average. So what you would do is you would take the square root of the average squared deviations conditional on a negative excess return. So those are your three main measures of downside risk. You can also look at the relative frequency of large negative 3 sigma returns. So 3 sigma returns would just be 3 standard deviations from the mean. These are called jumps. So let's say you calculate the relative frequency and you get a relative frequency of a 3 sigma jump of 0.16%. Pretty small, right? So if you were looking at this, this would be out of every 1,000 observations, 1.6 are 3 standard deviations from the mean. Now these are rare, but they would have a very large impact on an investment or on investment performance. So these are just focusing and looking at the large losses that are possible and looking at this downside risk and trying to measure it in some format. Now, taking a look at some historic returns on risky portfolios, you have Treasury bills being your no risk investments. As you can see, we do not have a risk premium because these are your risk-free investment. You have Treasury bonds, which essentially are certain to be paid. However, the prices, since they are bonds, would fluctuate as interest rates change, so they do impose some risk. Primarily price risk. And then you have stocks. So stocks being the most risky of this group. This stock benchmark is composed of New York Stock Exchange listed stocks, NASDAQ stocks, and Amex stocks. And this is from the period of 1926 to 2018. As you can see, the most risk, the highest average return. How do we measure risk? We're looking at standard deviation. As I mentioned, Treasury bills are considered these risk-free investments. However, sometimes the inflation was actually greater than the Treasury bill returns, meaning that your real rate of return was actually a negative amount since inflation was eating away at your purchasing power. But this is just a look at some of the historic returns on risky portfolios. We've talked about how to calculate risk by looking at risk premiums and looking at variance and standard deviation. And this is just showcasing here that as you increase your average return, that the standard deviation, the riskiness of those returns also increases. And then lastly, just looking to put some context into the returns on those common stocks, the historical distribution. As you can see, we have a lot more volatility in the returns. So we do have a larger group here, but we do have some extreme gains, but you also have some extreme losses over this almost 100-year time period. So you can see the volatility of stocks, greater volatility, greater risk, greater return. So that concludes this chapter 5. If you have any questions or comments, don't hesitate to reach out. Good luck, and I will talk to you all soon. Thanks.